The first is what possibly you would have seen in the press regarding sanctions on Russia, as well as disabling the SWIFT mechanism, etc. Some aspects which are meant to um, bring difficulty and weaken Russia's position. There are a few other things that I thought may also be of interest to a professional practicing in the tax realm or the regulatory realm. One is the revocation of Russia's MFN status. The MFN is granted a most favored nation benefit is given among trading partners. The US, European Union, and G7 countries have begun steps to revoke the MFN as far as the trade status for Russia is concerned. US US is also attempting to impose tariffs ranging from 3 to 32% on various imports from Russia. There are the few jurisdictions which have suspended information exchange with Russia, and US is contemplating denial of foreign tax credit for companies which continue to operate in Russia. On a slightly separate note, while talking about Russia, I thought it may also be useful to touch on a certain development where the EU is proposing to include Russia in a grey list as a part of the non-cooperative jurisdiction. The change, it appears, is not so much to do with the war in itself, but to tackle Russian offshore companies and try and force the Russian administration to comply with substance requirements as far as offshore entities are concerned. Given the main issue for discussion today, I thought it will be very useful to briefly touch on a couple of points, nothing to do with the Indian taxation, but flavor of what is happening, or rather generic information on what is happening across countries. OECD has issued a public consultation document on tax transparency framework. This is to do with information exchange and reporting of crypto. The guideline or the public consultation document talks about a certain due diligence procedure to be carried out to identify customers who platforms will enable to trade or exchange crypto assets. The paper also talks about a reporting by these exchanges of the aggregate value of crypto assets exchanged or transferred by individuals to amongst authorities or to a certain authority. The OECD paper does not deal with tax treatment of crypto assets in itself. On a separate note, you will also see a trend of various countries coming out with certain crypto tax measures. Costa Rica has released a public consultation document on tax treatment of transactions for virtual assets, including what should be done as far as VAT and capital gains is concerned. Australia is coming up with a policy framework as far as taxation of digital transactions on crypto is concerned. Moving on to the next point, OECD has introduced or has provided a toolkit for VAT on e-commerce. Very recently, it's released this toolkit. The toolkit basically talks about what is the kind of framework that one should be using to tax e-commerce companies, such as streaming companies, gaming companies, ride-hailing entities, online e-commerce platforms. How should countries go about taxing them, especially on the VAT side? This report notes that APAC is the largest e-commerce region in the world, far more than the Americas. And considering VAT as a very crucial source of revenue for this region, what are the measures, what is the kind of policy framework that a country should consider is contained in this. There is also a brochure, a very user-friendly aesthetic brochure of about 12 pages, which is more like an exec summary, and I've provided the link. You can take a look at the brochure to get a flavor of the entire toolkit. The OECD has released additional TP profiles. Before I go into the specifics, I thought I'll spend a few seconds talking about what these profiles include. They are updated, synthesized, or harmonized information on various aspects of TP legislation and practice in a particular country. OECD compiles this across various geographies and publishes them or updates them periodically. These profiles, the country profiles, typically include what is arm's length pricing and what are the methods that are used, what is the comparability analysis that can be used, how should one deal with intangible intra-group services, financial transactions, cost contribution, various questions. Information is solicited from the country itself, and these are compiled and published. In February 2022, OECD is releasing its third batch of TP profiles. In this, 22 profiles are updated, 6 new countries added, taking the total list of countries covered to 91. A quick update on some budgets across countries. Singapore has introduced, Singapore is in the budget as proposed introducing rules in connection with the 15% mop-up tax to implement Pillar 2. Interestingly, it is also talking about increasing the VAT rate from 7% to 8% with effect from 1st of Jan 23 and further to 9% from 1st of Jan 2024. South Africa is considering a reduction or is introduced a reduction of taxes from 28% to 27% for financial years or assessment years ending after 31st of March 2023. There are also certain guidelines that have been issued for public comments as far as intra-group loans and sale and leaseback arrangements are concerned. Cambodia had proposed to introduce capital gains tax that is being pushed to 1st of Jan 2024. Here I'm touching on a few tax incentive regimes that are used across countries or that have been introduced recently by three countries. The first is Malaysia. It's introduced something called a Global Trading Center incentive. This is again not very different from the trading center incentive you would see in Singapore. Certain changes and modifications. One is the tax rate is at 10% as against the corporate tax rate at roughly about 24%. This would be available for a period of about 5 years, extendable by another 5 years. If one has to qualify, an application has to be made by December 22. Qualifying entities are ones which are resident of Malaysia, have not carried out activities in Malaysia and use Malaysia as a base for undertaking qualifying activities. And for a trading center incentive, qualifying activities would include sourcing, procurement, distribution, whether it pertains to raw materials, components, or finished goods. This company has to comply with certain conditions, which includes hiring 15 full-time employees with a pay of roughly about 5,000 Malaysian ringgit per month for each employee. That's roughly about 90K per month in Indian rupees. It has to have a certain amount of capex and opex, which don't seem like a disturbingly high number. What one needs to understand is this entity has to have a sales of roughly about 300 million. The difficulty I see is there are two conditions. One is this entity has to have a sales of 300 million, which is roughly about 5,400 million in Indian rupees. And this entity has not carried out activities in Malaysia. For an entity which is setting up a base afresh in Malaysia and has to achieve this threshold of 300 million Malaysian ringgit in the year to be able to get this benefit does seem to be a little bit of a high benchmark. A patent box regime has been introduced in Italy. A deduction of about 210% of the total expenditure would be available for developing and maintaining qualifying IPs. Qualifying IPs would include copyrighted software, patents, legally protected model design, etc. There are instructions on what could be eligible expenditure, what are the procedures to qualify for the new incentive, what are qualifying R&D activities, etc. Interestingly, the paper also notes that for cases where the qualifying IP test is met at a later point of time, the weighted deduction of 110% is available once this test of qualifying IP is met. One can go back 8 years in time to be able to avail the weighted deduction. Australia has introduced a lower corporate tax rate of 17% for income from patents, which are in the medical or biotechnological sector. South Africa is extending the R&D deduction of 150% up to 31st of December 2023. Why am I talking about these set of incentives? India has done away with this deduction under the weighted deduction under 35 on R&D. If you look at the trend, a lot of countries are continue to incentivize R&D activity for the reason that R&D is what would increase employment and bring technology in and spur the economy. Maybe India should consider taking a relook at the phasing out of the R&D benefits. UK has introduced a new regime for qualified asset holding entity comes into effect from tomorrow, 1st of April 2022. The draft guidelines were issued a while back as a part of their finance bill, and there are certain amendments and updates. So I thought it will be useful to talk about very briefly what this scheme is. For one, some commentators also call this as quack. For a company to qualify as a quack, it has to be a US resident with 70% ownership by eligible investors. Its main activity should be carrying on of investment business, and that does not involve investing in listed companies. The objective and purpose of this scheme is to provide a UK intermediate holding company for structures, UK intermediate holding company structure for investment funds. It complements the existing and mature fund environment in UK by bringing in a framework for intermediate holding entities by these funds. There are certain tax benefits. Capital gains is exempt from tax subject to certain exceptions. Income from overseas property is also exempt. Very interestingly, interest payment on borrowings by quack is not subject to withholding tax. And there are certain exemptions and benefits available as far as stamp duty is concerned.
Proposed amendment on taxation of cryptocurrencies, issues and the approaches. Before starting this, this crypto space has been much talked about in the recent years. There has been a regulatory resistance for this space. And especially given the fact that last month, the finance bill has introduced certain tax proposals for the cryptocurrencies and for the crypto assets. A very common question that arises in everyone's mind about this is why the tax proposals are introduced even when there is no four corners of the regulatory framework was in place. And the answer to this lies in the exponential growth of the crypto tech industries in India. If the media reports are to be believed, crypto tech industry to grow to 241 USD million in India by 2030. The crypto tech market in India has a potential to create around 8 lakhs jobs. The economic value add of $184 million by 2030 in the form of investment and cost savings is expected. Presently, there are over 230 startups which are already operating in India in the crypto tech space. India has the highest number of the crypto owners in the world at 2.07 crores. With these facts and figures, I think we are all very, we are now being given the answer that why the tax proposals, why the crypto assets tax proposals was introduced by our finance minister in the last month, because I'm sure the revenue do not want to, with this facts and figures, I'm sure revenue do not want to lose anything in their kitty. Given this, having said this, now we know we should first understand what cryptocurrencies is. When we read about cryptocurrency, we generally see that there are some certain features which cryptocurrency carries with itself. One other feature to say that is digital and or the virtual currency. I think this is a very self-explanatory feature to understand. Then lies that the certain other features of the cryptocurrencies is they are secured by the cryptography means. They are based on something called as digital ledger technology. They are not issued by the central authority, and they are based on the blockchain technology. While we read about cryptocurrency and we study about the cryptocurrency, when we try to delve around the topic of the crypto assets or the crypto space, we often come across with these terms known as cryptography, distributed ledger technology. There is no central authority and it's powered by blockchain. But what it is, and for us, it is very important to understand these concepts, especially in the light of the fact that to understand what could be the possible taxable events in the entire crypto assets ecosystem. So to understand that, I will just take you through a brief on the technology of the crypto assets. So one of the term, as I mentioned, is something called as distributed ledger technology. Now we all wonder what it is. What is distributed ledger technology? To give you a brief background of it, conventionally in the banking ecosystem, there were supposedly in a very simple economic system, there are two banks, Bank A and Bank B. Bank A share its ledgers with central bank, and Bank B also share its ledgers with the central bank. However, these banks can access to their respective ledgers only. They cannot access to each other's ledgers. Now, what happens in such a scenario is, say supposedly there are certain individuals, say supposedly here in the example I have given, say there are two individuals who have deposited 100 rupees in Bank A. Now Bank A having 100 rupees, Bank B requests Bank A to lend some of the money. Bank A says, okay, I have exposure to that amount. I will lend you 90 rupees. Now what is happening is, this 100 rupees that are being deposited by these individuals suddenly becomes 190 when it enters in the economic system. Then what happens is, this Bank B lends these money out of this 90 rupees, they lends this money to an individual, say 80 rupees they lend. Now what has happened is, the 100 rupees that has been deposited by these individual has suddenly become to the tune of say 100 plus 90 plus 80, like 270 rupees. So it has created something called an economic bubble. So now what happens if, say supposedly, these two individuals one fine day, because of some panic or because of some economic panic or some any other reasons like that, they come to the bank and say, okay, now we have to withdraw the entire 100 rupees of ours. Now in such a situation, what would happen? Because in the economy, to their 100 rupees vis-a-vis 270 rupees are rotating. So this is an economic bubble, and this precisely was one of the main reasons for our global economic crisis in 2008. Post that crisis, there was one pseudonym, Satoshi Nakamoto, who came in with a paper known as peer-to-peer electronic cash system. Now, what is this peer-to-peer electronic cash system? In that paper, it was mentioned that why is the need for the central authority altogether, and why one cannot, read the ledger of each other to have a transparency. So it brought the concept of distributed ledger technology. In distributed ledger technology, what happens is there is no intermediary at all. And then there are Bank A and Bank B. Bank A and Bank B get the access of the ledgers of each other bank accounts. So basically, Bank A exactly knows what Bank B holds, and Bank B exactly knows what Bank A holds. So there is no intermediary, and the ledgers are shared between all the participants. So to briefly understand about the basic of the concept of distributed ledger technology is this. This is something called as a distributed ledger technology. Coming back to our next slide. Now, obviously, the question will obviously rise that if there is no intermediary, how will we assure the transactions are secured? That is why there's a concept of cryptography. Cryptography, as we all know, is a process where plain text is converted into unintelligible data. Just to say, the data is encrypted, the encrypted data is converted into a decrypted data, and vice versa. Why it is required? Because it is a secure means of communication, and it ensures that the message is transferred to the intended user only. It not only protects fraud or malicious intentions of the participant, but also what it happens is it authenticates the transaction also. So what happens in cryptography is, if say supposedly bank A intends to transfer 1,000 rupees to bank B. Now what will happen? Bank A will issue a public key. What is public key? Public key looks like this. Actually, the key is more broader. It has more alphanumerical digits, all that. Just for the example purpose, I have mentioned it like this. So bank A will have it will be having a public key. Then bank B will also have a public key. What these public keys are, what we can typically understand it as an email ID. If I have to, give a message to someone, what I will do is I will ask the email address. I will also having an email address, and we exchange the messages. Now what happens is, once bank B receives this kind of the message, that could only be generated by the means of a private key. And if the private key says, okay, authenticated, that means the transaction is secured. Vis-a-vis, in another example, if we say supposedly assume that some mischievous participant tried to tamper this amount of 1,000 to rupees 10,000. Now what would happen? This public key and the private key that would be generated by bank B will not match with the public key, and thereby the transaction, it will say it will not happen. Until now, we have understood what is cryptography, and we have also understood a little bit about the digital ledger technology. Now there's a concept of blockchain technology. What is blockchain technology? Blockchain technology is a chain of actions. So what happens is, in a blockchain technology, very basically, a transaction is initiated. There are multiple parties who may initiate the transactions. And all the transaction, including date, time, parties, amount, are recorded therein. Then the transaction is posted and record the transaction on the network. A block is formed. A block is added to that, and that particular block is something which cannot be deleted. A block once generated cannot be deleted. That block is broadcasted to all the participants in the system. So, very simple example, if we have to understand what blockchain technology is all about, let us just take one example of 4 friends, A, B, C, D. They went out for a dinner. A pays the entire bill, and say supposedly the other friends have to pay to A now, and their share comes out to be equivalent to 4 bitcoins. Now what will happen is, there's already a block in a blockchain of events which says that A has 10 bitcoins, B has 4 bitcoins, C has 3 bitcoins, and D has 7 bitcoins. So now what happens if B wishes to pay to A? So now B initiate a transaction to pay 4 bitcoins to A. This transaction, now since there is no intermediary, someone has to verify these transactions. Now who verifies these transactions? These transactions is generally verified by the participants, typically known as the miners. What they will do is, they will use their computing powers to verify these transactions. And what will they get to actually verify these transactions? They will be incentivized by crediting the cryptocurrencies by verifying these transactions. So now what has happened is when A, B, C, D already had a certain number of Bitcoins that was already mentioned over there in the block, and there is one miner who verifies it and the transactions takes place. There is one block to the event. Then what happens is now C also wishes to pay 4 Bitcoins to A for the dinner they had, his share of the dinner they had. Now we all, so now the newly updated data about the Bitcoins is, say A has 14 Bitcoins, B does not have a Bitcoin now since he has parted it to A. C has 3 Bitcoins and D has 7 Bitcoins. Now C has to pay to A 4 Bitcoins. Now what will happen? This transaction will not verify because it will not take place because C does not have that number of Bitcoins, so that will not happen. So what will happen is new block will be created to say, again, A has 14 Bitcoins, B has 0, C tried to pay A 4 Bitcoins, but it didn't happen. And then D has 7 Bitcoins. Now comes to the other transactions. Say supposedly now D also wants to pay his share for the dinner. Again, the transaction will be verified by a miner. He will be incentivized with the cryptocurrency. And at finally, this a block will be created to say that A has 18 Bitcoins, B has 0, C has 3, and these Bitcoins are reduced to 3 because he has parted 4 to A. So what is this? This is now the chain of events created in the block, and these blocks cannot be deleted. Say supposedly if we say third one block, which says that C tried to pay to A but didn't happen, that also has been created. You cannot edit the block any which ways. So any of the updations is that you can see in that block. Now what is this chain of events? This chain of events is nothing but a distributed ledger. This distributed ledger, everyone will have access to this distributed ledger in A, B, C, D. Everyone knows about it. And then the miners who verifies the transaction, they also have a data about it, about this transaction. So what was happening, what A, B, these transactions were verified. This is known as a verification process. This block of events, this blockchain, this entirety is known as a distributed ledger. This will be accessible to all. So this is all about briefly what is cryptography, what is blockchain technology, and why it was very important for us to understand is because now it will give us a fair idea of what could be the probable taxable events, which I will deal in the later part of my slides. Now we see who will be the participants in the cryptocurrency ecosystem, so they are the miners, which I just explained, who actually verifies the transactions, who actually solves a sophisticated cryptographic problems, and for that they're incentivized with the cryptocurrency. Then there are crypto exchanges where the bitcoins, where the cryptocurrencies are purchased and sold by the traders. Then there is something called as hash power rental company. So what does hash power rental company do as a participant in the entire ecosystem is, it buys the specialized computer equipments and the technology which is capable of mining of the cryptocurrencies, and then they rent it out to the miners who actually want to mine the cryptocurrencies. What they in the exchange of some fees or something. So it is nothing but something like infrastructure as a service is what they are providing. Then there is crypto wallet service provider. Crypto wallet is nothing but your cryptocurrencies are digitalized in the crypto wallet. It's just like a bank account where you keep in cash. So similarly, we can draw an analogy from there. Similarly, in a crypto wallet, the cryptocurrencies are credited or debited as such. And then there are the traders, casual traders, or the traders who actually buy and sell the cryptocurrencies through different platforms. So these are the participants in the ecosystem. And given that we had a brief on the technology and the participants, we'll be able to much better understand about the taxable events that would take place in the crypto assets space. Now, what are the pros and cons of cryptocurrencies? It is very actually important to know what would be the pros and cons, given that there's much talked about that it should be regulated, not regulated. the the tax regime which has been, which has come, which they say is not very investor friendly. So what are the advantages and disadvantages to it, and why the government is not very keen to actually, introduce something very happily in this space? So advantages are, they are cheaper and the faster money transfer. This solves the problem of double spending. Now, what double spending is, as I showed, as we learned in the earlier example, that 100 rupees suddenly became 270 when it entered into the economic system. So this is known as double spending. When the in the case of a cryptocurrencies, this issue can be resolved because there is no central authority. Everyone can access anyone's data and the ledger accounts. So this solves the problem of double spending. Then there is no single point of failure. As we had earlier seen that there were certain banks and etc. they had failed suddenly. So this can be avoided in this framework. It reduces the cost of intermediaries. As we have seen, like there are no intermediaries in between, and therefore it certainly reduces the transaction cost of a transaction. Then obviously it also brings the fair share of the disadvantages also. One is the price volatility. This is the major drawback of this cryptocurrencies. If you are sleeping the cryptocurrencies at one price and you will wake up, it could just either drop or just rise like anything. So price volatility is one of the major advantages of the cryptocurrencies. High energy consumption. They actually consume a lot of energy and the electricity, and they can be used for the illicit activities. In the beginning, when the cryptocurrencies was introduced, they were also used for many of the illicit activities, money laundering, etc. So these are some of the pros and cons of the cryptocurrencies. And we need to get the right balance to actually bring into this technology so that a lot of financial problems are being solved. Moving to the next slide about non-fungible token. Why I'm separately taking this to understand a non-fungible token is, in the tax proposal also, this has been recognized as a separate crypto class asset. There's something called a virtual digital asset, and there's something called as a non-fungible token. Non-fungible token is nothing but any asset can be digitally represented and tokenized. This is known as non-fungible token. So NFTs are unique cryptographic tokens that exist on a blockchain and cannot be replicated. NFT can represent real world items like artwork, real estate. An NFT can digitally represent any asset, including online. Only assets like digital artwork and real assets such as real estate. So you can digitalize any of the assets, be it the artwork, be it the real estate items. Even some time back, even you can digitalize your tweets also. Then tokenizing, once it is digitalized, then it is tokenized. It is tokenized and makes it possible for buy and sell and trading them more efficiently. And then what is the advantage of it? It is again powered by the blockchain technology, and it helps to identify the property rights in an asset. Now, very simply, we can understand what NFT is. So, for example, if someone is an art lover and wants to buy a painting of M.F. Hussain, that painting costs you around crores of rupees. And supposedly, if I'm an art lover and I don't have that much amount of money, that kind of the money, what will I do? But so suppose someone who is owning this painting that converts into NFT. I, being willing to buy this, willing to have the access to it, I will, when converted into NFT and tokenized, I will buy and I will buy this NFT. Now, what will happen is, not only I can get the right of the excess profits, which would be there in when its value would increase. Also, I can also get the access rights to it. One fine day I can access it for like 4 hours. One fine can, or maybe I will give the access rights to access it for 3 days in a month, something like that. So this is a very basic example what NFTs are. So now having a basic picture what digital assets are, digital assets which I spoke about, majorly about cryptocurrency and non-fungible token, NFTs. Uh, I would just technically take you through the what could be the probable definition around this generally. The word cryptocurrency is derived from the encryption technique, which is used to secure network. It is digital currency used over internet to purchase goods or services or trade it for profit. It is created using technology called blockchain, as we already discussed about that. And it started in 2009, just after it was the aftermath of the global crisis, with introduction of the Bitcoin. The Bitcoin was the first of the cryptocurrency that was introduced. Non-fungible token, as we have seen, it is a digital certificate representing the ownership or right with respect to indivisible asset, and they act as a digital twin to a physical asset, and it gives users a complete ownership of the digital asset, and it's actually also creates a proof of the ownership. And most important feature of it is it's powered by the blockchain. Now, as I have said earlier also, India was not very keen for the crypto asset space. It has, in the beginning, it has shown resistance to this space. So what happened is how they were showing resistance. In 2013, RBI, by press release dated 24 December 13, cautioned the users about the risk associated with the virtual currencies, including money laundering, consumer protection, market integrity, cyber security, and volatility. So this was the first of the press release that was, issued by the RBI, cautioning the investors to, to invest in the cryptocurrencies. Again, in 2017, RBI issued 2 precautionary press releases on the similar lines. The turning point came when RBI issued a circular which prohibited entities regulated by RBI from dealing in virtual currency. Then, in 2019, the committee proposed a fresh draft bill that recommended a blanket ban. So until now, the Indian regulatory authorities were quite resistant about this crypto space. Then came a major welcome point for, I think, the crypto industry as such, when the Supreme Court, in the case of Internet Mobile Association of India versus Reserve Bank of India, lifted the ban imposed by the RBI circular, and it lifted the ban on the constitutional grounds. Then in 2021, the Ministry of Corporate Affairs released a notification mandating companies to inter alia make certain disclosures with respect to virtual currencies, cryptocurrency transaction undertaken by them during the financial year. Presently, the Parliament has intention of introducing cryptocurrency and regulation official digital currency bill 2021 for deliberations. And the objective of the bill is to create and enabling a framework for the official digital currency to be issued by the RBI and to prohibit all private cryptocurrencies available in India. With this note, we can see that the approach of the government towards crypto assets was cautious initially from 2013 to 18. It was conservative between 2018 to 20, and then from the 2020 onwards, it has a positive outlook, largely because of the Supreme Court judgment, which lifted the ban, which lifted the circular of the RBI, and also because of the tremendous growth of the crypto industry. So then to 2020 onward, it's kind of seeking a positive outlook. With this, though, now we have a brief understanding about what the technology is, how the crypto assets work, what are the pros and cons, who are the participants in the cryptocurrency ecosystem. We'll be able to better understand the taxation of these digital assets. So the taxable events which are there in this spaces, one is creation of cryptocurrencies. One is the first one is mining. Mining, I have already discussed earlier how the mining happens and how and how the cryptocurrencies are generated through mining. Initial token or coin offering, initial tokens and the coins issued by companies developing new blockchain protocols to raise money or funds for their project. So it is akin to something as IPOs, that when the company has to raise funds, they issue shares. So I mean, we can draw an analogy from there. These tokens or coins are issued in exchange of cash or any other existing cryptocurrency. However, this is not much in practice now. And the other way to which the cryptocurrencies can be generated is airdrops. So in airdrops, the tokens or the coins are distributed free by the new companies in the crypto space, and which is usually done to, and it is usually distributed to famous people so that awareness is generated about new tokens and coins. The other leg of the taxable events could be when there is a secondary sale of the cryptocurrencies. Secondary sale of the cryptocurrencies can happen either through trading or exchange of goods and services. When I say trading, it is acquiring cryptocurrencies online through cryptocurrency exchanges or in a wallet. And exchange of goods and services, when goods and services are exchanged for cryptocurrencies, then also there's a secondary sale of the cryptocurrencies. So ideally, as we have seen the entire framework, that what the cryptocurrency is and how it works, what the technology is, what could be the taxable events, I think we'll be in a better frame of mind to understand what are the proposals by the finance bill on the virtual digital assets. To begin with, so the taxation of the VDAs, how they have done, they have bucketed into four categories. One is they have defined VDAs, what would be the virtual digital asset, they have defined that. Then is they have introduced a taxing regime for the VDAs under section 115 VDA, which is a newly inserted section. And the transfer of the VDAs, as they say in this section, would be taxed at a special rate of 30%. Then there would be a gift tax on VDAs. And last but not least, there would be a withholding tax provisions on the payments for the transfer of VDA to a resident. Now in detail, we will go through it, that what exactly the proposals are. So they have defined virtual digital asset. They have inserted a new section 247A, to define the term virtual digital asset. The definition is exhaustive, but they have defined in a very broad manner. Let us just understand what are the criteria they have placed for a digital asset to tantamount to be a virtual digital asset as per the Income Tax Act. So these are the criteria that you can see on the slide. One being, it is in the form of information, code, number, or tokens. So it has, it's very broad. It includes ideally everything, right from information, whether it could be a code, it could any number or a token. So everything they have tried to put under the bucket of VDA. Then another criteria is it is generated through cryptographic means or otherwise. So this term otherwise is very interesting, because even if a VDA, if a digital asset is not generated by the cryptographic means, then also it could be included under the definition of VDA. By putting this criteria, they have ideally broadened up to also include something called loyalty points, or the Sodexo coupons. All that they have tried to put into that. I mean, this could be the unintended consequence to bring out this broader definition, but yes, I mean, how it stands now, it may be interpreted in that light. Also, the other criteria is it acts as a digital representation of value with or without consideration. The other, so it has to have a digital representation, whether it is being given with or without a consideration, with a promise or a representation of having inherent value. Now, this is a very, very interesting point to note, inherent value. Why? Because cryptographies, it is always being criticized that the cryptocurrencies do not have any inherent value. Then what should take place to an cryptocurrency or a digital asset to be, come under the ambit of VDAs? Typically what happens as per the market practice, then when any cryptocurrencies is issued, they are accompanied with a white paper. In that white paper, they actually tell you about the technical details, they tell you about the concepts, they tell you about the plan for the future growth, etc. So that is accompanied when the cryptocurrency is issued. So I think what we can say is, what we believe is, there is in that white paper, there's a promise or representation or having an inherent value. With this, what we believe is cryptocurrency in that particular case, has an inherent value, and therefore it can be categorized as the VDA. However, as I said earlier, there are criticisms from past many years saying cryptocurrencies do not have any inherent value. So this could be again a gray area. It allows for the storage and transfer of its units or tokens and can be traded electronically. So these are some of the criteria, the basic criteria they have come up with in the definition of VDAs under section 247. You inserted section of 247. Additionally, in the definition of VDA, they have excluded government issued digital currency have been excluded from the scope of the virtual digital assets. Then NFTs have been included with the scope of the virtual digital asset, and it means such digital asset as the government in the official gadget may specify. Government is empowered to also identify digital assets that would be included within the scope of the term virtual digital asset. So what is happening is, so the government, the currencies, the Indian or the foreign currencies are excluded from the scope. NFTs are specially included, and in future government can notify any of the digital assets to be part of this definition of the VDA. So this is about the definition of the VDAs. What are the issues in relation to this VDAs could be? One is, I already explained that it is broad enough to also include digital gift cards, loyalty cards, etc., because it fits all the criteria of what is there for an digital asset to be a VDA as per the Act. So, but it could again be an interpretational doubt, and it could be an unintended consequences, but obviously the clarifications are yet to come on this. And very interestingly, they have included NFTs in the definition of VDA. As we have learned in the earlier slide, that NFTs are a different type of the crypto asset altogether. They are kind of the collectibles, and they have the notional values. So this asset class requires a nuanced tax structure, as they are very unique. So they require a separate tax structure so that they can be valued differently, because these are the separate class of the assets altogether. So I think we need some clarification around this part also. Taxation of the cryptocurrencies. Now we move it to the taxation part of the cryptocurrencies, how it will be taxed. Very first question that has always been come up in our minds is, what would be the classification of the virtual digital asset? Now, see, it has not been clarified whether this VDA would be a currency or a commodity or a security. However, in the absence of such clarification, VDA should be classified as a capital asset. Why so? The term capital asset has been defined in section 2, clause 14, which says that a capital assets means any property of any kind held by a person, whether or not connected with his business or profession. So this definition is very wide enough, and the courts on the various occasions have taken a view The definition is very wide enough to also include any kind of the interest, every possible interest that the person can acquire, hold, or enjoy. So it does not have a statutory meaning, but ever since the courts have taken a view that there could be it's a very broad definition to include any kind of the interest. So it could come under the classification of a capital asset. Now, under which source they will be taxed? They will be taxed either as a capital gains or the business income, depending upon the intention of the person. Like if say cryptocurrencies are NFT should be deemed to be a capital asset if they are purchased for investments by the taxpayers. And therefore, gain arising on transfer of such assets shall be taxable as capital gains. However, if the transaction in such assets are substantial and frequent, it should be held that the taxpayer is trading in such assets. In this case, income from the sale of such assets should be taxable as business income. So if the transactions are very frequent and if they're very substantial, it will be considered as the business income. Otherwise, it will be considered as the capital assets. Now, how the taxation will take place under the head capital gains. What would be the nature of the VDA? The nature of the VDA, if the gains are arising from the transfer of virtual digital assets are treated as capital gains, then in that case, the further classification obviously is required, whether it will be a short term and long term, and that would depend on the period of holding of such assets. If the virtual asset is held for more than 36 months from the date of the purchase, it will be considered as long-term capital asset, otherwise short-term capital asset. So the gains from the virtual digital asset would be a long-term or a short-term capital gains depending upon the period of holding. No deduction to be allowed. So this is very interesting that in the finance proposal as it presently is, no deduction would be allowed for any cost, anything except for any expenses, etc., except for the cost of acquisition. So while computing the short-term or long-term capital asset, except the cost of acquisition, if any, no other deduction or exemption shall be allowed. You could see that I have marked the expression if any in red. Why so? Because this term has been introduced in the finance bill as passed by the Lok Sabha on 25th March 2022. So what happens is the courts, including the Supreme Court in the case of BC Srinivasan Shetty, have taken a view if the cost of acquisition could not be determined, or if the cost of acquisition is nil, or for any such reason the cost of acquisition cannot be derived. In such a case, the computation mechanism fails, and if the computation mechanism fails, there arises no liability towards the capital gains, and the capital gains will not be chargeable to tax. To avoid such kind of the interpretation or to avoid such kind of the litigation in future, the finance bill, as is passed in the Lok Sabha recently, they have added this term if any. So even if the virtual digital asset do not have any cost of acquisition, the computation mechanism will not fail, and they will be liable to tax as per one newly inserted section 115 BBH. Having said this, the following items shall be ignored. I mean, there will be no deduction that will be allowed except for cost of acquisition. Even the expenditure incurred in connection with the transfer of a virtual digital asset, cost of improvement relating to a virtual digital asset, indexation of cost of acquisition of virtual digital asset, and exemptions under 54F. No deduction, no exemption shall be allowed in computing the gains from the virtual digital asset except for the cost of acquisition. And even if one cannot derive the cost of acquisition because of any reasons, then also the computation mechanism would persist, and it will be chargeable to tax as is. So only the only cost that will be allowed as deduction would be cost of acquisition. Now, tax rate. In the newly inserted section 115 BBH, they have proposed that the virtual digital assets will be taxed at the rate of 30%. Does, even if it is a short-term capital gain or a long-term capital gain, any kind of gain it is, it will be taxed at a flat rate of 30%. Further, no deduction, as we have earlier said, will be allowed either in Chapter 6A or 54F or any on such capital gains. However, relief under 87A can be claimed. Very interestingly, when this newly inserted Section 115 BBH, which actually gives you the how this transfer of the VDAs will be taxed, it didn't had a non-obstant clause. I mean, so but it didn't had a, in other words, it did not had an overriding effect. But when the finance bill that was passed on 25th March 2022 in the Lok Sabha, it imported the principles of the overriding effect in that section, particular section. Non-obstant clause was previously missing, and this could lead to an argument that it does not override the other provisions of the Act, and thereby the tax rate of 30% provided under Section 115 BBH may not apply in case where the lower tax rate is provided under any section of the Act. Just to avoid this kind of a confusion, they have introduced it. They have introduced a non-obstant clause in the section, and now it is a overriding section, and only a tax rate of 30% is applicable, and no beneficial tax rate under any other provision of the Act would be given to an assessee. With this, moving ahead, how the computation of virtual digital asset would take place if it is regarded as a capital asset, full value of consideration, cost of acquisition, if any. This is a very very interesting term which they have introduced, because now even if you cannot determine a cost of acquisition, your computation mechanism will not fail. And then you derive a long-term or a short-term capital gains. Very interestingly, they have not defined what is sale consideration and what is cost of acquisitions in the tax proposals. Again, there could be it could surround a lot of litigations around this. So this is about if a virtual digital asset is held as a capital asset, then the capital gains will be computed. It will be computed as a long-term and short-term depending upon the period of the holding. And even if you cannot determine the cost of acquisition, then also the computation mechanism will not fail, and it will be chargeable to tax at the rate of 30%. With this, if there's a trader who frequently trades in the crypto assets, then what happens is it could be treated as a business income. And in such a case, income from sale of such assets should be taxable as business income. The gains, again, no deduction, no allowance towards any expenses shall be allowed, and the gains will be taxable at a flat rate of 30%. Very interestingly, when we consider the definition of transfer that is defined under Section 247, we always, it starts with transfer of a capital asset. It is always in relation to a capital asset. So when the proposals were initially, proposed for this, for the tax of the crypto asset, there was, what if the VDAs are not held as a capital asset? Then what would happen? Because then it's not a transfer, and then person will not be liable to be taxed under newly inserted Section 115 BBH. So for that, what the bill as passed by the Lok Sabha on 25th March 2022 has inserted a new subsection under this section to provide that definition of transfer shall apply to any VDA, whether held as a capital asset or not. So if supposedly a VDA is held, there's a trader who frequently trades in the crypto assets and is chargeable to tax as a business income, also on its transfer of the VDAs, that would be chargeable as, would be considered as a transfer as per Section 247 of the Act. Now the issue arises. We have seen that how transfer on transfer of cryptocurrency, there could be a taxation either under the head capital gains or of business income. But what will happen in case of the crypto miners? Are they covered under the regime of the newly inserted regime of Section 115 BBH? Because for the crypto miners, as we discussed in our earlier slides, the cryptocurrency is not transferred to them, it is generated by them. So how how will the new regime impact them, or will the new regime will impact their taxability also? The bill has not addressed the tax implications which could be faced by the crypto miners, and this again remains a gray area. Now, treatment of losses. What happens for the treatment of the losses? No set-off of any loss shall be allowed to the assessee in computing the income arising from the transfer of any VDA. So no loss whatsoever shall be allowed to the assessee. No set-off of loss can be allowed to the assessee for computing the income of the VDAs. Interestingly, so no set-off of loss from transfer of the virtual digital asset shall be allowed against the income computed under any other provision of this act. I'm reading this word other right now. To the assessee, and such loss shall not be allowed to be carried forward succeeding the assessment years. If we read this clause with the word other, what could ideally be meant is that if you have a loss from the VDA, it cannot be set up from the other provision of the act, but it can be set up from this provision of the act, that is 115 BBH. So what it meant was, what it could mean was that a loss from a VDA can be set off from the income of the VDA. So, however, they never intended this. So the government, while passing the bill in the Lok Sabha very recently on 25th of March, removed this word other. Now this word other has been removed from this provision. Now what it means is no loss from the VDA, no loss of the VDA can be allowed from the income of the VDA also. So ideally what has happened is any loss that is there from the transfer of the VDA will be a dead loss. It will not be allowed to be adjusted against income arising from transfer of another VDA, whether of the same category or not. So if there is, so under the new taxation regime, no set off of loss and no carry forward of loss is allowed, and there is no set off of loss of the VDA is allowed even from the income of the VDA itself. So this is very interesting that all the losses from the VDAs are the dead losses and they lapse. Illustration which will make us understand about how it will work. Supposedly, Ram purchased 1,000 bitcoins at ₹1,000 each on 12th August 2020. He transferred all the bitcoins in the previous year 22-23. The capital gains from the transfer of the bitcoins shall be computed as under. On 18th April 2022, Ram sold 1,000 units. For the considerations is supposedly for 5 lakhs. He paid the brokerage for 1,000 rupees. The cost of acquisition for the 1,000 units was 10 lakhs. That is 1,000 multiplied by the 1,000. In this case, the taxable profit in its case would be 5 lakhs. That is cost consideration minus cost of acquisition. There will be a loss of 5 lakhs. And the brokerage, etc., will not be allowed in such a case. Another 1,000 units of the bitcoins will be supposedly is sold by Ram on 18th March 2023 for a consideration of 16 lakhs. He paid the brokerage of 1,500. The cost of acquisition was 10 lakhs. In this case, the taxable profit comes out to be 6 lakh, that is 16 lakh minus 10 lakh. No allowance for the brokerage shall be given. Then the question is whether this the loss of 5 lakhs could be set off against the income of 6 lakhs. No, because now with this with the removal of this word other also in the section, This shall also be not allowed. So sale consideration less cost of acquisition only shall be taxable. No deduction shall be allowed for the brokerage also. Loss of 5 lakhs on sale of Bitcoins can be set off against any other income, including gains from sale of Bitcoins, cannot be set off. And such loss also cannot be carried forward. So this is how, the tax proposals are around loss and carry forward of the set off and carry forward of the losses from the Bitcoins. Now, deduction of tax at source. Deduction of the tax at source, they have newly inserted section 194S for this. New section 194S is proposed to be inserted in relation to payment of consideration on transfer of VDA, and this is applicable from 1st July 2022. So if there's a transfer of a VDA, and there's the transferee would have to deduct TDS on such amount of transfer. So let's see what are the requirements under section 194S. Deductor: any person responsible for paying any sum by way of consideration for the transfer of a virtual digital asset is required to deduct tax at source. So a person responsible for paying sum of money for the transfer of virtual digital asset is liable to deduct the TDS on such amount of transfer. Who shall be the deductee? Tax is required to be deducted under this provision if the amount is payable to a resident person. Time of deduction: tax shall be deducted at a time of payment by any mode or at the time of credit of such sum to the account of the resident, whichever is earlier. So at the time of payment or credit, whichever is earlier, tax is required to be deducted. What could be the rate of tax? The tax is required to be deducted at the rate of 1% of the consideration, and if the deductee does not furnish his PAN to the deductor, tax shall be deducted at the rate of 20%. So these are the four pillars of section 194S, stating who could be the deductor, who could be the deductee, when you have to deduct the tax, and what will be the rate of the tax. Now, very interestingly, what happens if typically cryptocurrencies are purchased and sold with the medium of the cryptocurrency exchanges? When you are buying a cryptocurrency over from the medium of the cryptocurrency exchanges, you do not know the counterparty. So now what will happen? Who will deduct the tax? How will this will happen? In such a situation, even if the crypto exchange steps in to deduct the tax, there also would be a problem. Why? Because crypto exchange has to, take the details of the users, whether it would be a specified person or not a specified person. So in such a situation, what would happen is how to deduct the tax. So I think presently how it looks like, the crypto exchanges will have to deduct the taxes. They have to, take the details of the users, and they will facilitate. The buyers to deduct tax on this on behalf of the buyers. But what if the crypto exchanges are located in the foreign jurisdiction, which is very probable? Then whether they would be required to obtain PAN, TAN, etc. This also is a concerning area for this. Requirements under section 194S. Amount on which tax is to be deducted. So tax is required to be deducted from the gross amount of the consideration paid to the resident person for the transfer of virtual digital asset. So it has to be paid on the gross amount. However, in the following cases where the transfer of the consideration is not wholly in kind, what happens in those cases is, before releasing the consideration, the person responsible shall ensure that tax required to be deducted has been paid in respect of such consideration for the transfer of virtual digital asset. What are those cases? Where consideration is wholly in kind, where transaction is in exchange for another virtual digital asset, and there is no part in cash, and where consideration is partly in cash and partly in kind, but part in cash is not sufficient to meet the liability of deduction of tax in respect of whole of such transfer. Very interestingly, what was there earlier, the initial proposals as introduced in the finance bill is, they have used this expression as the person responsible shall ensure that tax has been paid. These word required to be deducted has been recently inserted when the bill passed in the Lok Sabha. So there were doubts around this. What if the tax has been paid could be interpreted as if the person has paid the income tax. Is that a sufficient compliance to understand the sufficient compliance for Section 194S? Therefore, to remove this kind of the ambiguity, they have introduced this the expression required to be deducted has been paid. So the person responsible has to see that the tax has been deducted when the consideration for the transfer of digital asset is not wholly in kind or partly in cash and partly in kind. And if the transaction is for the other virtual asset, in such a cases, they have to see that the tax which is required to be deducted has been paid. Now, they have provided certain threshold exemptions from the deduction of tax at source. So the threshold limits are where the consideration is below 10,000. No tax shall be deducted under this provision if the consideration is payable by any person other than a specified person. We will see who are the specified person in the next paragraph. And its aggregate value does not exceed 10,000 during the financial year. So for the other than specified person, at the threshold limit, it does not crosses 10,000. So that is a threshold limit for the exemption. Consideration is below rupees 50,000. No tax shall be deducted under this provision if the consideration is payable by the following specified person and its aggregate value does not exceed rupees 50,000 during the financial year. So who are those specified person? An individual or HUF whose total sales, gross receipts, turnover does not exceed 1 crore in case of a business or rupees 50 lakhs in case of a profession during the financial year immediately preceding the financial year in which such virtual digital asset is transferred. An individual or HUF who does not have any income other than under the heads of business or profession. So there are two threshold limits that are being given under this section. One is 10,000 and 50,000. 10,000 is applicable to a person other than the specified person, and specified person we have seen who are the specified person, and the threshold limit for 50,000 is being given for the persons for the specified persons. Now, here are certain instances and the examples which will help us to to have a clarity on this section 194S. So what happens if on 1st of March 2022 there is a VDA is being transferred for cash and the consideration is 25 lakhs. The PAN of the payee is also available and the payer is a specified person, is not a specified person. In this instance also the TDS will not be applicable because the date is 1st March 2022 and at that time there was no TDS provision in place because this is effective from 1st July 2022. In another instance, on 1st July 2022, if the VDA is transferred for a consideration of 8,000 in cash and the payee has PAN, payer is a specified person, then also the TDS will not be applicable because payer is a specified person and it does not crosses the limit of 10,000. In the next example, what we can see is there's a consideration of 48,000 in cash. Payee has a PAN. payer is a specified person, then also the TDS provision will not be applicable, because payer in this case is a specified person, and for the specified person, the threshold limit is of 50,000. Then if in case that the consideration is of rupees 25 lakhs for cash, payee has a PAN, payer is not a specified person. In that case, the TDS will be applicable at the rate of 1%, because they have exceeded to the threshold limit. In the next instance, the same consideration in cash on the same date, however, PAN is not available with the payee. In that case, TDS would be deducted at the rate of 20% under section 206AA, as per 206AA. In another instance, if supposedly, the VDA is transferred in lieu of a property, payee has a PAN, payer is not a specified person. In such a case, deductor has to ensure that the tax required to be deducted has been deducted and paid. So this is very important to note, that in that case also the deductor should see that the tax has been deducted and paid to the government. Moving ahead to section 194S. Now section 194S has an overriding effect. The overriding effect to this section is given by two clauses that were initially proposed. One is where a transaction is subject to TDS under section 194O and 194S, tax shall be deducted under section 194S. This is newly inserted section. So if 194O is applicable on the sale of goods and services for the online transactions, in such a case, if there's some transaction that is liable to deduct TDS under section 194O as well, in that case also 194S shall prevail first. So it has an overriding effect. The other the clause which was introduced initially when the finance bill was proposed, however omitted when the finance bill has been passed by the parliament, by the Lok Sabha, therein there was one clause stating that a transaction in respect of which tax has been deducted under this provision, no tax shall be deducted or collected under any other provision. So how these clauses were introduced? These clauses were introduced when, if 194O is applicable, 194O and 194S shall be applicable, then 194S shall prevail over it. And if in any other section, if the TDS has been deducted, then there will be no requirement to deduct TDS under, if the TDS has been deducted under this provision, there will be no requirement to deduct TDS under any other provision. So it had an overriding effect. However, when they omitted this clause, so now what could be the scenario? Now what they mean is, essentially what the legislation means is, even if you deduct TDS under this section, then except for 194O, you are liable to deduct TDS under the other sections also. What this essentially means, let's just take an example. That the CA has provided a professional services to a client, and client pays him in form of bitcoins. Now what happens is, obviously the client will deduct TDS for the professional services under section 194J. Now with the omission of this clause, that if in other section the TDS has been deducted, there's no requirement, if it is liable to deduct here, then there is no liability to deduct TDS under any other section. This has been omitted. Resultantly, what has happened is, now client has deducted TDS under section 194J on the professional fees given to the chartered accountant. However, chartered accountant will also be liable to deduct TDS under section 194S because of this provision. Why? Because there are two legs of this transaction. One is the client is paying the bitcoins in lieu of the professional services. So obviously he'll be liable to deduct TDS under section 194J. and chartered accountant, it will be considered as a chartered accountant is, is buying buying the crypto, is buying the bitcoins in lieu of the professional services rendered by him. So it would be something like there's a transfer. So that is why the chartered accountant will also be liable to pay tax under section 194S. So this could be the possible implications of removing this clause from the section, that a one transaction could be seen as two legs, and tax could be deducted under two sections. Gifting of virtual digital asset. As we have seen, let us just first see the scope of section 56.2.10. Section 56.2.10 applies when a person receives any benefit whose value exceeds rupees 50,000. The provision is applicable notwithstanding the residential status or class of the assessee. The donor or the donee can be individual, partnership firm, LLP, company, AOP, BOI, cooperative society, or artificial judicial person, whether resident or non-resident. So if any person receives any benefit whose value exceeds 55, that would be a deemed income under this provision on account of the following transaction. If he has received any monetary benefits without consideration, if someone has received immovable property without consideration or for inadequate consideration, and if someone has received specified movable properties without consideration or for inadequate consideration. So the movable properties under this sections have been specified. So the question is, obviously the next question that may arise is whether the VDAs are held to be the properties under this section. Yes, the tax proposals as it have been laid down by the finance bills says that so what will be the deemed income under this section, where any property is received without consideration and the aggregate fair market value of which exceeds 50,000, the whole of the aggregate fair market value of such property will be chargeable to tax. Where any property is received for a consideration that is less than aggregate fair market value of the property by an amount exceeding rupees 50,000, the difference between the fair market value and the consideration is chargeable to tax. So this would be the deemed income as per 56.2.10. They have also specified the movable property under this section. In both of these situations, the provision will be applicable to a property in the nature of the shares, securities, jewelry, archaeological collections, drawing, painting, sculptures, any work of art, bullion. Where the transaction involves any other movable property, excess of the consideration of fair market value shall not be chargeable to tax. Therefore, they have now to gift the transaction of gifting of VDAs, to tax the transaction of gifting of VDAs under this net. They have specifically mentioned the term virtual digital asset under the ambit of the property. So Finance Bill 2022 proposed to include virtual digital asset within the scope of the movable properties. Thus, if a person receives a virtual digital asset without consideration or for inadequate consideration and the value of such benefits exceed rupees 50,000, it shall be taxable in the hands of the recipient under section 56.2.10 of the as income from other sources. So if a person transfers the VDA, is transferred the VDAs, it could be subject to the provisions of 56.2.10, because the term property now includes the term the term virtual digital asset. Now, what would be the tax rate in gift of VDA? The value of the benefit arising under this provision shall be taxed at the rate applicable to the assessee. Why? Because such income shall not be taxed. Such income shall not be taxed at 30% under 115 BBH, as it does not arise due to transfer of virtual digital asset. So when you give someone a virtual digital asset, as in the case of the airdrops also, there is no transfer per se. And since there will be no transfer, that cannot be categorized under section 115 BBH. If they will not be categorized under 115 BBH, The tax rate that should be which would be applicable to the assessee would be taken into consideration in that particular case. However, what happens in the other leg of the transaction when the recipient further transfers such assets? In that case, the resultant gain will be taxable under the head under section 115 BBH. As we have seen, there are no valuation rules, and to determine the fair market value will be quite challenging in the cryptocurrency crypto assets in the absence of any guidance on this. So I think some guidance on this around this on the valuation rules are awaited on from the legislation. Applicability of the equalization levy. This is another gray area. The Finance Act 2020 has expanded the scope of EL to apply 2% EL on the amount of consideration received or receivable by an e-commerce operator from e-commerce supplier services made or provided or facilitated by or through it to a person resident in India, to a non-resident in certain specified circumstances, to a person who buys such goods or services, or both, using internet protocol address located in India, collectively known as the specified persons. Given this, the broadened definition, broadened scope of the EL, this could be a possibility that because of the broadened scope of the e-commerce operator or the supplier services, it is possible that the transaction in VDA by the Indian users, especially the buyers on the foreign crypto exchange, could be subject to EL. However, the finance bill has not provided any clarity on the applicability of EL on foreign crypto exchanges. With this note, we have seen all the tax proposals. We have seen how it works, how the technology of the crypto assets work. Given all this, it's obviously a welcome move for the industry because it provides a lot of clarity on the open questions from the income tax perspective. But we can see there's a government discomfort on this area. Why? Because they have equated this as similar to gambling transaction, and it stems from the government discomfort again. And there are still certain clarifications required in the tax regime, as we discussed. What would be the issues and which require further clarifications, as there certain lacunas still exist in the tax proposals. But more or less, it's a very welcome move. There is, looking at the growth of the crypto industry, looking at how the transactions are taking place, and looking at the fact that millennials are very much interested in the crypto space and they're investing in the cryptocurrencies. These kind of tax proposals were much awaited and much needed. Why? Because they have fully clarified, but they have provided certain clarity that how the crypto taxation in India would take place and what is the roadmap to it. And this will also certainly give us some clarity on the regulatory aspects also, that there is intention, there is or there may not be, there is some intentions of the regulatory bodies also to regulate the crypto assets. How does one give effect to VDA transaction in tax return up to 2023, assessment in 2023? That is, should one take deduction for the amounts other than the cost actually spent, benefit of indexation, loss, and decision in the case of BC Srinivas Shetty? So these provisions, this regime, this taxation regime is applicable from 115 BBH is applicable from 1st April 2022. So before that, if there is any transaction, they should be charged to tax as per the provisions, other provisions of the Income Tax Act. And the other provisions of the Income Tax Act gives us the fair idea that you can, take the benefit of the allowances and the expenses. Given that, if it is regulated, yes, you can take that. But there are the black clouds around this. If it is tomorrow considered as to be illegal, or if it's considered it's not illegal, Then for the illegal activities under the Income Tax Act, as we all know, there no allowance are no deductions are allowed. So as if now it doesn't look like illegal and should be, it should, the cost should be allowed as deductions.
Super. Thank you, Richa. Richa, I had one question. I put it in the chat box. Basically, the question is whether these reward points, they will be subject to the virtual digital asset provisions.
As the definition stands now, yes, because it is meeting all the criteria. It is a token information code. It has a digital representation of value. It has some inherent value. It can be stored as a unit. It represents some value. All of these criteria, and they are not generated. They are generated by the non-cryptographic means. So all these criteria looks like they are presently met, by the reward points. So it looks like it would be, considered as VDA as of now, but it could be an unintended consequence also by the legislation. So this remains again, a gray area, and it has been much talked about in the past 2 months that whether it would be a VDA or not. But yes, the clarification is much needed. And very interestingly, Lok Sabha, when passed the bill recently on 25th of March, they have not, given a clarity to this aspect. They have only, provided, when where there was some liberal view which SSC could have taken. Only that part, I guess, they have taken care of. For example, the losses, they have removed the word other to say that the loss from the VDA will not be allowed from the income of the VDA.
Exactly.
For the cost of acquisition, they have, put on the expression of if any, just so that the computation mechanism will not fail if we would have taken that stand. So all this, what they have done is, even if we, try to look to take the liberal view, how the law for taxation of cryptocurrency is being drafted, they have clarified it to their interest. And it clearly gives us the impression in the picture that these proposals are not very crypto investor friendly. So given this in mind, we should, take the taxations of crypto assets in future.
Understood. Because Richa, the question particularly comes because of the amendment to that budget proposal by way of subsection 3. So subsection 3 widens the scope. Whether it is a capital asset or not, it is regarded as a transfer. And then the more dangerous provisions are the provisions which restrict deductions in subsection 2 of 115 BBH. So the reward point companies, when they have their regular expenses apart from the cost of acquisition, again, there if we see with these reward point companies, there is no acquisition, so to say, to which there is a cost. So I mean, we get into a whole loop virtually such that their entire expenses could get disallowed. So which is a fairly very, very wide reading, which inevitably comes out, and like you said, it's just a collateral damage and maybe wholly unintentional. So I think we just have to wait and watch on this.
Correct. Or also, this will largely impact the cashless economy, contrary to what the government is thinking about the cashless economy. Because if the reward points, if say supposedly the cashless, any points that why it is given to incentivize the cashless, purchases or the sales. If that is not allowed, if deductions to those companies are not allowed, if the set off or the carry forward to those companies are not allowed, it will entirely hit the purpose of the recent inclination of the government towards the cashless economy. So yes, but we need to see the space more on this.
Right. Super. Richa, we have one more question, basically on the GST implications of this, if we consider it as a business income. Would you want to take it, or would you want to let it pass because you wanted to focus?
Yeah, because GST perspective, I think that's what I have understood. There's no clarity on the GST part presently. However, I think I would, because since I'm not the right person to speak on the GST, so
no problem. Super. I think those are the questions which we had. Just a second, actually, sorry. There are some questions in the Q&A box.
Yeah, I've opened that already.
Yeah. So
The other
goods
question
or
comes.
services, I think from a GST
Sorry?
standpoint, I think we'll leave that.
Yeah.
Yeah. The third question, if you can just see.
Yeah, I'll just take up the other question, which is for the case where VDA income is treated as business income, deduction of for cost would be available, right? Deduction for cost would be available, right? Because that is the only cost that is allowed under that scheme of 115, newly scheme under 115 VBH. But apart from the cost of acquiring that cryptocurrency or crypto asset, no other cost will be allowed. Next question is, how does TDS provision work in case the amount is, sorry, how does the TDS provision work in case the amount is payable to a non-resident also? Also, in case where the trading is run through platform outside India, how will TDS provision work? Do we have any clarity? As I explained earlier, also, if you buy a cryptocurrency from a foreign exchange, it's a gray area whether foreign exchange has to obtain a PAN and TAN and to comply with the TDS requirements of 194S. But we do not have clarity as of now. The next question is, in case where there is consideration in kind, you had mentioned that deductor is required to ensure that tax is deducted and paid in respect of such consideration, right? So ultimately, it means deductor is required to deduct and deposit tax with the government. Yes, I mean, because he has to ensure that, so he will ensure that the TDS is paid.